This is Open Interest. I'm Matt Muller alongside Sonali Basak and Katie Greifeld.
Let's take a look at what markets were doing during that press conference. You have S&P 500 futures at their lows right now. Besson said that he won't comment on who was talking to who when it comes to China. He did say that the U.S. has had substantial talks with Japan, that they're very close to a trade deal on India, but we have to talk about Amazon here. This was really interesting. Punchbowl reporting overnight that Amazon will soon display the added cost of U.S. tariffs on individual products. Again, that is according to Punchbowl. You can see shares are down about 2% right now because Caroline Leavitt said that this was a hostile and political act by Amazon. Sonali.
Yeah, very interesting and targeted comment, of course, by the press secretary. We're going to bring in Bloomberg's Tyler Kendall. She is in Michigan. This is where President Trump will hold a 100-day rally tonight. But first, let's talk a little bit more about the direct reaction. Of course, they talked about tariffs, they talked about taxes, and they talked about Amazon specifically. What does this say about the White House's reaction to companies around the push-pull with these tariffs? Prices are going up. Amazon might start to sit here and tell you just by how much. The follow-up question, Tyler, was, isn't Jeff Bezos still close to the president? What is Amazon's story saying about how the rest of corporate America might have to handle inflation?
Yeah, hey, Sonali. Well, the White House is very defensive of its policies, particularly as big box retailers came to the White House last week and urged the president to pull back on his tariffs because we could potentially see empty shelves in the coming weeks. And we've heard that from across the sectors, including the autos particularly, saying that they might have to hike prices for consumers as soon as next month, May, which is just in a matter of days. It is clear that this White House has been feeling the pressure from these companies, but they also don't want to let up on their tariff policies that they say they are staking their economic agenda on. Now, when it comes to those automakers, since I am here in Michigan, Caroline Leavitt did confirm our Bloomberg News reporting that President Trump is expected to sign an executive order that could offer some reprieve to automakers. Now, a White House official does tell us that this is expected to reduce or prevent the stacking of levies that automakers often face. So while we are not expecting the actual rates that automakers' auto tariffs are in place, that 25% tariff on foreign autos, as well as a 25% tariff on auto parts expected to come in on Saturday. Very likely automakers now will not have to pay those other tariffs that could get stacked on top, like steel and aluminum. And we're also expecting automakers to actually be able to get a partial reimbursement back when it comes to auto parts. So clearly, the administration trying to thread the needle here, at least offer some sort of reprieve. As Treasury Secretary Scott Bessent there didn't give us much details exactly, but did say that this is a focus on reshoring manufacturing in the United States.
Yeah, I think it's interesting, especially, Tyler, after we got all those really bad polling numbers out. To be fair, from outlets that are not necessarily super Trump-friendly, CNN, NBC, and others, but bad polling numbers, and now the White House is making it clear they really don't want consumers to see how much tariffs are adding to the prices of goods that we all need. That's why they say it would be a hostile and political act for Amazon to show consumers that information. They also don't want that to happen with cars, right? Because if you stack tariffs 25% on 25% on more for parts, you're going to see auto prices rise by maybe more than half.
Right, exactly. And it's also, I think it's fair to say, this is also part of why we're starting to see the administration really focus in now on its tax plan, since the White House is really banking on getting that through as soon as possible to get more cash into consumers' pockets and quickly. You had the Treasury Secretary there saying that they think that tariff revenue could actually help to offset some of the bigger tax priorities. We should also note it's unclear how exactly that would happen, considering that the tariffs aren't codified by Congress. They're not going to be in the Congressional Budget Office scoring, which could kind of complicate the math here. But Treasury Secretary Bessent yesterday came out saying that they actually want to see reconciliation done by July 4th. That is considered to be a very ambitious timeline. Senate Majority Leader John Thune said that it was aspirational. Instead, they're really looking towards that X date as the hard deadline for lawmakers to get the reconciliation package through. I did speak to one senior aide to Senate Republican leadership who told me that the chamber really isn't expecting to complete any work on this till actually August. So the administration, though, really pressuring lawmakers against tell you actually one other thing, Matt. President Trump told Michigan Republicans who were supposed to be here tonight not to come, to stay in Washington, because that is the sense of urgency this White House is pushing lawmakers to get through their tax agenda as they deal with the fallout from consumers and retailers alike when it comes to their tariff plans.
Certainly a sign of the times there. Bloomberg's Tyler Kendall reporting from Michigan. Looking forward to your coverage all day long. But let's keep the conversation on autos going, because GM suspended earnings guidance and froze plans to buy back $4 billion in shares due to uncertainty around tariffs. Bloomberg's David Welch is our Detroit bureau chief. He joins us now. So that's just part of it, David. They also postponed their earnings call from today to May 1st because they simply don't have enough clarity right now. And I guess it remains to be seen whether they'll get that clarity by the start of May.
That's right. They're looking for some kind of detail. I think last night they were preparing their earnings, the press release, the numbers, everything like that. And there were news reports breaking into the evening that Trump was going to give some sort of relief on auto tariffs. There's still no detail out there, or at least not a lot of it, on what that is. So it's tough for GM to affirm, not affirm, or even update their guidance. So they suspended that. They had a $6 billion share buyback that they had announced in February. $2 billion of that is already funded. That was the accelerated plan that's supposed to be completed in the second quarter. So the money was actually sent to the banks. That's going to be done. The other $4 billion that didn't have any kind of end date on it, it could theoretically even stretch into next year. But that's what's being sort of indefinitely held until they have clarity on tariffs, what that means for profits, what that means for cash flow. And I think GM's like a lot of companies right now, where they don't know how to plan the business because they don't know about all the devils and the details of the trade policies.
It's not just American companies, it's European companies as well. Matt knows I really want a Porsche. And maybe it might be more difficult to buy one, but they actually cut their profit outlook because of these tariffs. What to make of the international car industry right now based on what they've said?
Look, it doesn't make sense to have one small Porsche plant in every market where you do business, right? Because even though people really like these expensive sports cars, you just don't sell enough of them to have a big plant in America, another plant in China or South America or wherever. So you have to do a lot of exporting if you're a niche car company like that. And I think what they're saying is they're not sure what tariffs, whether they pass along some of the cost to consumers or eat some of it, what it's going to do to their business. So yeah, it's going to weigh on Porsche's profits one way or the other, whether it lowers sales or it lowers their margin on the vehicles that they sell. There's a theory that if you've got $100,000 for a Porsche, you also have $125,000. But people who can afford those cars didn't get that wealthy by giving their money away. So everybody is price sensitive to some degree.
If you are getting a Porsche for $100,000, then you're not getting a 911, which means it's probably not
Gotta
made
buy
in
it
Stuttgart.
used.
David Welch, very good point.
Gotta buy it
people
used.
forget, used cars, great choice. David Welch out of Detroit, where he is our bureau chief and wrote the book, literally, on Mary Barra and General Motors. Now, UPS is among the big earnings movers today. Another one that pulled its guidance. Let's get the details from Bloomberg's Red Brown. So, Red, this is one of many companies this morning that have said we can't give guidance, we're flying blind.
Yeah, I mean, it's to kind of what David is speaking to there. It's really difficult to plan, make a business plan when you don't know how things are going to look within a week, right? So let alone months out towards the end of the quarter. So even UPS, with so many tentacles stretched so far across the economy, getting so much real-time data, can't really plan out what they think the rest of the quarter is going to be. Rest of the year is going to be. We are getting some of their second quarter guidance coming through right now. So the company's saying they expect to get $21 billion in the second quarter. Estimates calling for around $21.1 billion. So still right in line with what the expectations were. But still, the rest of the year is still kind of a big question mark.
They also have plans to cut 20,000 jobs this year, UPS. That is due to reduced shipments from Amazon. So that was
by
really
more than
interesting
half.
as well.
That plan announced earlier, but by more than half, they want to cut shipments for Amazon.
They're also going to close dozens of facilities. But let's keep the theme going, flying blind, not literally when it comes to JetBlue, but they did pull their guidance.
Yeah, they did. And kind of, I guess, probably expected with them. Delta, American Airlines, Southwest all either withdrew or declined to reaffirm their outlooks this quarter already. So, JetBlue is already a company that's struggling. Another one of these companies going in the midst of a turnaround while the economy is struggling. And then, again, demand is just not necessarily there for air travel.
But maybe sea travel. You see Royal Caribbean hiking their outlook. Something I realized just a couple weeks ago, there was a great Wall Street Journal story about Coke versus Pepsi. Coke actually not making their concentrate out in Ireland and therefore maybe benefiting. Are we seeing that in their outlook right now?
Coke makes it obviously here, top secret in Atlanta. That makes sense because it's an American company, right? Pepsi. The weird thing is that Pepsi makes their formula in Ireland.
Right. And it used to be an advantage, but maybe not today.
Yeah, no, it's interesting because it's like, these companies that are so multinational, some people were worried about them being more exposed to the tariffs, right? If you're shipping things in from all over the country, it seems obvious. But for Coca-Cola, it seems like they had a really strong quarter. It seems like people are still buying their sodas. Sales did fall slightly from last year, but the company has really strong pricing. Price mix was up 5% in the quarter, 9% in the quarter before that. So the company still is able to charge higher prices for their sodas.
When it's addictive, it's pretty easy. Your pricing strength is increased when what you sell is addictive, right?
Yeah, absolutely. People like sugar. People like soda. Red Brown, we appreciate your roundup as always. Matt, you brought up this point. You take a look at the year-to-date chart of Coca-Cola versus Pepsi. It's pretty astounding. You have Coke up 16% on a total return basis. You take a look at Pepsi, down 11%.
Look at that. Joe pulled up the chart on the
Talk about a pair
He's so
trade.
fast. And Joe, by the way, if you look at that, if you look at it over 1 year or over 2 years, it's equally bad. Pepsi has really underperformed Coca-Cola.
You know what's up 36% on the year? Celsius, out with the new cherry cola flavor. Just saying, if you want to talk about addictions, I've got one.
Let's also take a quick check on the overall market right now because we're sitting at session lows when it comes to futures. The S&P 500 down 0.5% right now. We know a lot of that pain is coming through with big tech, with Amazon, hostile act, as the press secretary of the White House said. We'll continue to follow these markets up next. This is Open Interest. Let's turn to healthcare now because Hims and Hers Health is absolutely flying right now after announcing a partnership with Novo Nordisk. Novo will be offering its popular weight loss drug Wegovy through Hims and other pharmacy platforms at a reduced price. Let's talk about it now with Bloomberg's Madison Muller, who reported on this. And Madison, I get why this is great news for Hims, but why does this make sense for Novo to go this route?
Yeah, so this makes sense, especially right now, because we are coming up on the end of the compounding era of weight loss drugs, which we've talked about on the show. During widespread supply shortages last year, these compounding pharmacies sort of teamed up with telehealth companies to sell cheaper knockoff versions of blockbuster products like Wegovy and Zepbound through these telehealth platforms. And we're coming up on the end of that because the drug makers can now supply enough of their drugs to satisfy demand for the market. That means the FDA is going to start cracking down on some of this compounding, potentially leaving hundreds of thousands of patients that have come to rely on these cheaper drugs without access to medicines. So Novo, I spoke with them and they, have been looking at this and making sure that they are there to step in when patients are eventually cut off from the drugs. They rolled out this cheaper option for Wegovy last month, and now they're expanding that to partner with these telehealth companies that have sold these compounded drugs in order to potentially reach more patients.
Madison, it is much cheaper, right? It's less than half of the cost of otherwise getting Wegovy in America, but it still costs like a car payment. And if you look in other countries, admittedly, this is data from 2023, but you can get this stuff for $100, even less in some places a month. These companies have always told us it's because of the middlemen that their prices are so high in America. But does this really pull back the curtain on that argument?
A little bit. I mean, this does show, because what they're doing, you're right, that this direct to patient or direct to consumer option is cutting out the middlemen in some cases. And so we're seeing a reduced price that maybe lines up a bit more with some of the discounts and rebates that insurance companies are getting on the list price of the medications. That being said, it's still, even at this reduced cost, a lot higher than it is in other countries. And that's something that lawmakers like Bernie Sanders really called attention to last year. The CEO of Novo Nordisk testified at a Senate hearing about the prices of his company's drugs. That's something we've also actually seen President Donald Trump call out this year. The fact that Americans pay much higher prices for medications than elsewhere in the world. So that is something that there's been a lot of focus on, and Novo has tried to reduce that price and that criticism by bringing down the cost of their medications, but it still doesn't line up to what other patients in other countries are paying.
Madison, we only got about a minute left here, but I want you to talk to me about Pfizer, because the results kind of left for wanting. They did not give details on tariff impacts. Others have, and they also have, of course, that failed obesity drug experiment. How do you think about their path moving forward?
Yeah, I mean, that is something I think people have been asking for a long time. You know, we've seen Starboard get involved in Pfizer, and there's a lot of questions about what will be their next big hit. People were looking at obesity to be that next thing for Pfizer, and that really hasn't panned out. I mean, we've seen other companies. It's really been a challenge to develop an obesity pill specifically. That's somewhere where Lilly has been excelling, but it's been a bit harder for other companies like Pfizer. And there's really a question still of what is going to be the next big hit after COVID for them, which we've been saying for, almost 2 years now. But when it comes to tariff impacts, we are seeing some uncertainty in the healthcare space.
Yeah, some big questions over Pfizer's pipeline. Bloomberg's Madison Muller, appreciate your time. Now, coming up less than 5 minutes to go until the opening bells, we'll walk you through all of the action with Anastasia Amoroso. This is Open Interest.
Moments away from the start of trading, this is Bloomberg Open Interest. I'm Matt Miller. It looked like we would have maybe a positive day because we could get a reprieve on auto tariffs, but you can see futures down 0.5% because Caroline Leavitt at the White House said that showing consumers information about tariffs leading to price hikes is hostile and political. Here's the opening bell on the New York Stock Exchange. Jim Cramer ringing the opening bell, a fantastic and unique human being who has been hosting Mad Money, an iconic show for 20 years. Great to see him there at the NYSE. And down at the NASDAQ market site, you can see the funny hats. That's because this is Churchill Downs. They wear these hats for the Kentucky Derby, right, which is coming up this weekend, like the most exciting 20 seconds in sports. And Churchill Downs has been down big, off 33% year to date. Hopefully they put in the right bets on Saturday. Katie?
All right, let's take a look at some specific names to watch because we're in the heart of earnings season, and we heard from UPS this morning that it plans to cut 20,000 jobs, also to close dozens of facilities. That's as Amazon package volume plummets. It did not update its outlook, and it's certainly not alone in that, Shanali.
Yeah, I am looking here at General Motors, one of those that did not update its outlook. In fact, they've suspended guidance, and they're freezing share buybacks as well. That's on tariff fears. GM also moved the earnings call to Thursday as the White House weighs auto tariff relief. It's down 2.12% at the market open, Matt.
As we've been talking about, apparently plans to show consumers how tariffs contribute to higher costs on each product, if they do. This according to a report by Punchbowl. But the White House press secretary, Caroline Leavitt, said that is a hostile and political act. And at that point, if you look at the futures chart, they just come dropping down. So the market did not like that reply from the White House. However, we have been in an uptrend lately, and JP Morgan's trading desk has turned tactically bullish on U.S. equities. The team says that the de-escalation trade which is what we're going to see out of Michigan and President Trump today, has room to run as low liquidity and light positioning likely push markets higher. We are joined by iCapital Chief Investment Strategist Anastasia Amoroso. And Anastasia, great to have you here. Thanks so much for joining us. What do you think about this? Okay, a little bit of a blip because Carolyn Levitt buried Amazon, but otherwise, the Trump White House has been de-escalating on tariffs, and they're expected to continue tonight. Do you like this market?
Look, it's a puts and takes market, and obviously, got some positive news flow that we are seemingly de-escalating the tariffs that were highly escalated around April 2nd. So that's a positive, and I think that can continue. But at the same time, the markets have to grapple with what is happening on the ground right now. And what is happening is the shipping volumes, for example, are tanking, and you have the potential for layoffs. And I think we'll see that in the numbers this week. And clearly, there's a lot of supply chain uncertainty and repositioning that's taking place. So the market has to absorb all of that. But net, I would say, Matt, that if you zoom out from the day-to-day or the intraday market volatility, I do think you have a more constructive setup right now where technicals have corrected, and at the same time where I do think we've seen peak tariffs, and there's likely a path lower from here. We've heard it once again from Secretary Besson this morning that China's tariffs are unsustainable, and they truly are. And when you think about the economy that's been built, in a way that supply chains are so globalized, you can't just unravel that all at once. So I think we have to roll some of that back. And at the same time, we're likely to have deals with South Korea and Japan and all of that. Maybe it's not going to dominate the news flow every single day, but I think that's the direction of travel. So my point is the end game is not where we are today, but it's something else and something better.
Well, Anastasia, let's talk a little bit more about this specific moment and how you use it, because Matt mentioned the uptrend. We've seen the S&P 500 post 5 straight days of gains, which maybe it didn't feel that way. You have JP Morgan on one side turning tactically bullish, but you have Goldman Sachs on the other side saying that they're actually turning or remain tactically defensive. They're using this sort of relaxing that we're seeing across asset volatility to add to hedges, to reload on some of those defensive stances. And I wonder if that's the move here.
Yeah. The way I think about it is, what's the time horizon for the money that you have at hand? And also, are you fully invested or do you have cash to deploy? So if the time horizon is short term and you're fully invested, yes, I do think that playing defense in the portfolio makes sense. And also, we've liked private credit to continue to, because you can get paid while you wait out this volatility. So that's for the existing portfolios, and still prioritizing things like staples and utilities and real estate, and actually anything that benefits from potentially lower rates. So that's the current stance, the short-term stance. But if you do have long-term capital to deploy, and if you have cash on the sidelines, these are not moments, but these are periods of adjustments that you should use as an opportunity to add to long-term risk. So if the time horizon is, 2 years, 3 years, 5 years or more, absolutely. It's not often that we get a 15% drawdown, an opportunity to deploy that cash. So for that pool of money, I would be looking to take more risk. It's just that I wouldn't expect a quick payoff on that in the next couple of months.
Yeah, speaking of quick decisions versus long-term potential pain, you had that Amazon reaction. We've been talking about it all morning since it happened, but then in the last couple of days, talking about Shein and Temu raising prices, particularly on U.S. goods. I want to point out also that the trade deficit this morning was a record. It was $162 billion. It was worse than anybody expected, more than all analysts surveyed by Bloomberg. Consumer goods being imported was a big part of that, front-running those tariffs. What does this mean in terms of the inflation situation heading into the rest of the year? Our own Anna Wong makes this great point that this is the time that retailers want to prepare for the holiday season and the rest of the year and back to school. But it's a tough time, and it could be through the end of the year.
And I think prepare they did. That's exactly what the playbook for a lot of retailers, a lot of companies has been. They've been fast tracking a lot of those imports. If they're importing cost of goods sold, clearly they've been doing that in anticipation of the tariffs. So this is actually pretty good news, I would say, for the margins of those companies and also for the wallets of the consumers. This is why, for example, you look at some of the early reads on inflation in April, we're not seeing a huge pickup in prices, because I think a lot of what's on the shelves today so far has been been previously imported. And it's interesting, Shonali, the Dallas index that came out yesterday, exactly, something like 55% of the respondents said that they're going to increase prices, but the rest actually did not say that. And they're either going to use existing inventory or maybe they're going to onshore some production, although that was about 6% of those respondents. And then some others said that they're going to use inventory that they previously had or some existing production capacity. So the point is, you have the situation that we're expecting the core PC print this Wednesday to come out at 2.6% year over year. And you might actually see that inflation trend lower in the next month or so. And if you couple that with labor market weakness, which I think we will start to see, that's the license to cut rates for the Fed.
And I think we're pricing in like 5 rate cuts.
Almost 4 through the end of the year.
Almost 4, Shonali says. And I believe her.
3.7.
Still, that's a full percent, right? So is that good news, or does this market say, oh, that's because unemployment's going to climb to 5%? That's bad news.
No, look, I think it is good news, and it is warranted, especially if you take all the political back and forth aside. If you look at the data itself, if you have inflation at 2.6% and the potential for it to trend lower, if you have the unemployment rate that weakens a little bit, if you have consumer confidence that's really near record lows and business confidence has plummeted as well, and by the way, you look at financial conditions, they've tightened significantly since the start of the year. So if you were just looking at that setup and that picture, what would you do as a Fed? You would likely cut interest rates. So I think the markets would welcome that. And if we do have to go through the trade and tariff uncertainty, if we can cushion that with rate cuts, which, by the way, that's what eventually happened in 2019 as well. And that's what ultimately turned the market back around.
Well, maybe we'll get some clarity from the Fed on that May 7th meeting. I don't think anyone is quite expecting that, though. Anastasia, it's great to see you. That is Anastasia Amoroso of iCapital. Meanwhile, let's take a look at some of the stocks moving underneath the surface right now, right after the opening bell. We'll do that with Isabelle Lee.
Hey, Katie, we're looking at Hilton. So the company's boosting its adjusted EPS for the full year while lowering its net income guidance as the travel outlook wanes. So as we know, hotel companies as well as airlines really face a lot of uncertainties in the face of rising tariffs. You have the shares kind of flat now, aging 0.8%. We have the Hilton CEO saying that travelers are in a, quote, wait and see mode. The company did beat expectations for the first quarter, but that's before tariffs roiled the markets. Up next, we're looking at Royal Caribbean. So this is a different story. The company raised its profit outlook for the year. You see the stock there edging slightly higher by 0.6% as cruise demand continues to defy the increasingly dire travel situation. We have the company saying that bookings grew in April from last year and that cancellation levels are normal. The company also still sees full year capex of about $5 billion. And last, we have JetBlue. So it's back to the gloom for us. And you see the stock there dropping by as much as 3%. So JetBlue Airways just becomes really the latest company to pull its full year financial outlook following in the footsteps of Delta Airlines and others. So JetBlue focuses largely on domestic travel, which is mostly affected by the waning demand because of the trade war. The company said unit revenue, which is a measure of fares and demand, could fall as much as 7.5% this quarter. So that's not such a great look. Back to you guys.
Isabelle, we thank you so very much. That is Bloomberg's Isabelle Lee. Now coming up, UPS announcing a plan to cut 20,000 jobs due to reduced Amazon shipments. We're going to take a look at the company's first quarter report next with Citi's Ariel Rosa. This is Bloomberg Open Interest.
All right, it's time now for Top Calls. Some of the analyst action in focus this morning. And first up, Netflix upgraded to a strong buy over at CFRA. The analyst says that the streaming giant's recent results reinforce the view that Netflix has a unique competitive position, down a little bit today. Next up, this is a fun one. Hims and Hers cut to a hold over at TD Cowen, saying that shares could be range-bound with weight loss drugs no longer in a shortage. But that was before Novo announced a partnership with Hims to sell Wegovy, not range-bound right now. Hims up about 26%. Maybe we'll get an update. Finally, ConocoPhillips cut to neutral over at Bank of America. Analysts say that Diamondback Energy has an edge over Conoco. Remember, the oil giant reports earnings on May 8th, Matt.
All right, May 8th, we will look forward to then for, we'll get Alex Steele on the program on May 8th. One stock on the move today is UPS. It is rising after announcing it'll be cutting, no, now it's down. It was rising. It was a little bit up. Now it's a little bit down. They announced they'll be cutting 20,000 jobs in an effort to improve profitability. The street likes that. It also beat first quarter revenue estimates. The street likes that. But it said it can no longer tell us what's going to happen for the full year. It pulled its forecast, and the street does not like that kind of uncertainty. Joining us now is Rosa, senior Citi transportation analyst. He has a buy rating on the stock with a target of $123. And Ari, I guess I want to ask how firmly you can stick to that target if not even UPS knows how this year is going to turn out.
Yeah. Hey Matt. Thank you for having me on. So it's a great question. Look, right now there are a lot of moving pieces, obviously, in the global economy. No one's really sure. And as you pointed out, UPS pulled its guidance, right? So that obviously makes it harder for us. And we kind of, we're shooting in the dark a little bit in terms of developing forecasts. Their earnings call actually just ended about 15 minutes ago. So we're going to go back to the drawing board and kind of try to adjust our estimates as best we can. And, as I mentioned, we're kind of shooting in the dark a little bit. That said, look, the stock has been very beaten up. It trades at one of its cheapest valuations in a long time, close to a 7% dividend yield, which is near its highest in history. And one of the things that's really notable, the company did $1 billion buyback this quarter, which is significantly higher than what they do traditionally. And so they're kind of indicating to you that the stock is cheap. So we feel very comfortable with our buy rating. In terms of where the actual price target settles out, it's a little harder to say because, again, there are a lot of moving pieces. But I do think that UPS stock is quite cheap at these levels, and quite a lot of bad news is being discounted into shares.
Fair enough. I mean, the dividend yield and the buyback alone should also be good news in addition to some of the measures they're taking. But to speak to the uncertainty just a little bit more, how wide is your range of outcomes for this company, given the pressures around tariffs, given the pressures consumers might feel with inflation and what they might end up getting delivered? Do you have a set of outcomes from worst to best?
Yeah, absolutely. So it's a great question. As we think about the historical range, and we kind of try to develop our price targets based on obviously just a P target and then an earnings number. In terms of earnings, it's a lot harder to say where that might go. And again, there's variability around that. What we saw is in 2024, UPS actually had its worst operating margins in a decade. And so the stock had already been under quite a lot of pressure. We've already seen, idiosyncratic challenges, Amazon cutting down their business with them. We've seen their union got some pretty significant concessions when they renegotiated their contract about 2 years ago. And so there have been already a lot of pressures on UPS, and that's the reason the stock has been kind of soft over the last year or 2 years. But at the same time, in terms of valuation, the PE ratio now trades at a substantial discount to the broader market. And we don't think there's a lot of downside risk to that multiple. And so really then it becomes a question of what is the earnings number, not only for 2025, but what does really a more normalized earnings number look like? And look, we don't think that global trade is going to cease. We think there's going to be some sort of, I don't want to say benign resolution to the tariff, to tariff discussions, but it seems really hard to reverse these things that have been put in place over decades, right? It's not about one administration. It's not about, one country even, right? It's really about global supply chains are deeply integrated, and UPS plays an essential role in that. And again, that's the reason that we feel comfortable with our buy rating. It's the short-term call is tough. The longer-term call we feel a lot more comfortable on.
Does that hold for the entire transportation landscape? Because I'm taking a look through your notes. You write you prefer rails over trucks right now. So in that very integrated supply chain that you're describing, I mean, are some factors, some sectors of it poised a little bit better here? Yeah. So the reason we prefer rails is, frankly, they're just better businesses, right? The rails have extremely diversified end market exposure, high barriers to entry, I would say almost impossible barriers to entry, really attractive margins. They generate a lot of free cash flow. Whereas truckers, it's low barriers to entry. It's extremely competitive marketplace right now, especially because really since the pandemic, you've had this excess capacity that hasn't been worked through.
And that's put a lot of pressure on rates. It's put a lot of pressure on margins. And the net result is trucking stocks have been quite beaten up. So if you're looking for safety, rails all day, I think, are the place to be. If you're looking for that higher beta trade where you might see surprise upside, especially, frankly, if we get a little bit more of a downturn in the economy, you could see some of these marginal carriers start to exit the market. And that actually could be very supportive for rates over the medium term, which could in turn help trucker earnings. But definitely rails are kind of the safer, higher quality play in the in transports, at least right now.
Ari, we thank you so much for your analysis. That is Ari Rosa of Citigroup. Now coming up, Amazon shares are lower after the White House press secretary had this to say about plans for transparent pricing on tariff products.
I just got off the phone with the president about Amazon's announcement. This is a hostile and political act by Amazon. It's another reason why we are onshoring critical supply chains here at home to shore up our own critical supply chain and boost our own manufacturing.
This is Bloomberg Open Interest. I'm Matt Miller. Let's get a check on what's going on in stocks. And we're looking at a little bit of negativity here, but not too much. You can see we're only off by 0.04% on the broader benchmark S&P 500. The NASDAQ is down 0.1%, probably because Amazon has a bigger weighting there. And it really is all about Amazon. I'll get to that in just a second. But you can see Tesla is also off and General Motors is down. We're hoping to get a reprieve for car makers and car parts today as President Trump goes to Michigan. Hims and Hers is absolutely soaring because they're going to offer Wegovy for the low price of $499 a month. So either you get a car or you get skinny. UPS is down but 0.6%, and Amazon, really the big news of the day after this company's attempt at transparency, giving consumers information on pricing, was attacked by White House Press Secretary Caroline Leavitt. Katie?
All right, let's talk about that with our Caroline Hyde. So this was according to Punchbowl reporting that Amazon would start showing these after tariff prices. Obviously, that has landed them in the crosshairs of this administration.
Yeah, no announcement. Amazon has not in any way confirmed that this is exactly what they were considering, but the Punchbowl report that is based on a person familiar is citing that they would indeed make it very transparent as to how much more expensive your goods are going to be. In fact, today Amazon wanted you probably talking about the Prime Day that's coming in July that they made an announcement on. They probably wanted you talking about the luxury store they're doing with Saks online, but no, we're now all focusing on whether or not they will really do what Caroline Leavitt is calling a hostile act, because that transparency is really going to make it very clear to consumers how much more expensive their goods are becoming. Now, remember, according to Bloomberg Intelligence, about 70% of all goods sold on Amazon come from China, whether that's largely through their third-party vendors, which, of course, are going to be looking to pass on some of those costs, or indeed Amazon itself, which has been trying to renegotiate if they've had deals coming due. We've heard from Andy Jassy doing interviews on other networks saying, look, we are going to renegotiate if that contract has come due. We're going to try and protect the consumer. And, of course, that means, sorry, supplier, you're probably going to have to suck up some of this margin hit as well as us.
Yeah, your SPLC function on the terminal will show you just how much that consumer alone matters, 50% of the revenue. And, of course, earnings after market on Thursday. But the follow-up question to Leavitt was about Jeff Bezos' relationship with the president. What can you say of that? And can they essentially be told by the White House, bullied even, to turn this decision around? Of course, as you said, Amazon did not announce this. This was reported earlier by Punchbowl.
Bezos is the founder, but he's not running the business. Andy Jassy is running the business. Andy Jassy is the guy who's been on the phone to the White House and railing up to all of the new administration when we sat down with Andy Jassy earlier this year. So it's really up to him. Of course, the founder owns a lot of stock. Of course, the founder has, I'm sure, a lot of credence with Andy Jassy, who used to work for Jeff Bezos before he took the helm. So that's going to be notable. But as it stands, it's an independent company that's going to be running things as it sees fit.
Right, looks like Bezos does have a pretty big stake.
I would imagine so.
And a lot of sway.
He owns
He's
about
a
a tenth of the company. We'll see if the president and Caroline Leavitt can scare him out of showing consumers how pricing works. Caroline Hyde, thank you very much for joining us. Coming up in the next hour, B of A's Jill Carey Hall, then Rebecca Minkoff talks tariffs' impact on the fashion industry. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Let's take a check on these markets right now. The S&P 500, it briefly erased its losses. Now it's down a little bit here. We're trading in a very low volume range after 5 straight days of gains, the longest streak since November. You can see that some of that momentum has faded. Maybe we'll get some movement now, though, because we do have some breaking economic data, Matt Miller.
Yeah, we got job openings, the JOLTS job openings numbers, and they are worse than had been expected. We were looking for 7.5 million job openings, and it's coming at 7.192 million. In terms of the quits, that's actually a little bit better than expected. More people quit than we had been estimating. 3.19 quits was what we were looking for. We actually got 3.33 million quits, and you want to see, more people quitting. You want to see that kind of confidence, right? Mm-hmm. That they'll find another job or just be chill without one. In terms of consumer confidence, we got a number that was worse than had been expected, and a number that was far worse than we got last month. So the Conference Board's reading of consumer confidence at 86 is worse than the 88 that the survey had predicted, and much worse than the 92.9 that we got previously.
Right. And we have to remember this is all ahead of the jobs report on Friday as well. You are seeing a little bit of a movement here in the S&P 500, even lower now. It was about flat just a few minutes ago, now down about 0.1%, but yields also lower. You're seeing that drop off in the 2-year. We heard it from Anastasia Amoroso a little earlier, building a case for a rate cut, right? Mm-hmm. That is the idea here as you take a look at the bond market. But yes, of course, as we've been talking about, guys, the direction of travel is tough on jobs.
Layoffs also were not as bad as we'd expected. So quits higher, layoffs lower.
This is all the appetizer, though. I mean, what matters is what we hear on Friday, the official data. But it is interesting to see JOLTS in the run-up. We'll get ADP as well. And some of this soft data just worsening and worsening. But when that turns into hard data, of course, is what people will trade on.
And I have at the top of my notes for the show today, I've written SLOC. In all caps, because Torsten put out a note on Friday's jobs numbers, and he said, listen, reminding us, the survey week for the employment report was the week after Liberation Day. Those tariffs were announced. So there are significant risks, Torsten SLOC of Apollo says, that the number is going to be lower, perhaps even negative. Joining us to talk about this is Jill Carey-Hall, head of U.S. small and mid-cap strategy at Bank America Securities. Jill, first of all, good morning. Thanks for joining us. What are you expecting on Friday? What are you expecting from this economy as we finally enter a period where the economic data shows the effects of Liberation Day?
Well, we're still expecting economic growth to hold up, but our economists have revised growth lower. They're expecting 1.5% U.S. GDP growth this year. If you look at the 4Q over 4Q, it'll be about 1%. So I think not only the jobs data, but as mentioned, there have been these divergences between soft and hard data before. I think what'll be important as well for the consumer is, real wage growth has still been positive. Some of the layoff numbers, as you mentioned, have not been skyrocketing. So I think all of these data are important to monitor for the consumer. And what we're seeing from earnings trends is certainly some weakness there. You've seen a lot of the airlines pull guidance. We've seen weaker trends for not only consumer discretionary, but even consumer staples companies. So continuing to look at those trends as earnings season progresses. We have seen a beat so far for the S&P 500 this earnings season, but a lot of that has been driven by some of the other sectors, financials, communication services, et cetera.
All right, Jill, let's get straight to the small caps. Your specialty, something that I love to talk about. It's interesting. You had this bull case for small caps forming that because they're very domestically focused, maybe they would be a little bit insulated from the trade tensions that are taking down the mega caps. That hasn't been the case. We're showing the year-to-date chart right now. The Russell 2000 is actually the worst performer by a big margin when it comes to the S&P 500 by the NASDAQ 100. What went wrong, Jill?
So we've been cautious on the Russell 2000, and there's a couple of reasons here. We have actually had the view that trade tensions would be a bigger risk for the Russell. These companies have much thinner margins, so the potential earnings hit from tariffs could be much greater in that size segment. The foreign exposure of small caps is lower, but that gap with large caps has narrowed over the years, and these companies can still, have supply chains where they're not able to be as nimble with moving them as some of the mega caps. And all of this is at a time when small caps are still struggling to emerge from the earnings recession that they've been in since 2023. And Fed expectations have been very important for small caps, where we at BofA are expecting the Fed to remain on hold this year. Inflation has obviously been sticky. So I think that small caps, especially the Russell, could still be challenged near term until we see a bit of a turnaround in earnings revisions, guidance, some of these expectations, or if we see an environment where the Fed is able to cut more. We do like mid caps. They've actually been the best performing size segment year to date. You've had cleaner balance sheets, some better earnings revision trends within that size segment. Earnings could be less hit by tariffs there. But overall, I think given this backdrop, it's important to be selective. Our analysts here cover about 1,000 small and mid caps, and there are still a lot of opportunities that have sold off and are stocks that could have stronger margins. So the attributes that we've seen working within SMID have been stocks that have strong margins given the tariff risks, stocks that are higher quality, profitable, stocks seeing positive revisions in an environment where revisions have been coming down broadly.
Joe, one question I have is if you're concerned about the impact of tariffs or inflation or this larger strategy from the White House impacting small and mid caps, what about taxes? At the end of the day, this is the other part of Trump's strategy here to bring business back to the economy in the United States. There's a huge set of employers in that small to mid-sized business community. It's pretty critical here to the job market. How much do taxes and relief, therefore, set a different tone? Does it help at all?
Lower corporate taxes could be a benefit. It would unfortunately not be as big of a benefit to earnings as we saw last time the corporate tax rate is cut, especially if it were to only be for domestic manufacturers, for example. So that could be a modest positive boost to earnings, but the uncertainty related to tariffs could be, a much more negative hit if some of the tariffs were to remain in place. I think the other positive could be if we see deregulation, which could benefit parts of small caps. If we see, M&A pick up, that could benefit certain sectors within small caps. And, really longer term, I think if you have a long time horizon, the relative valuations of small versus large could argue for a longer outperformance cycle, particularly if we see factors that benefit domestic mid-cap stocks like reshoring of U.S. manufacturing, like a sustainable CapEx cycle in the U.S. So I think on a multi-year basis, small caps could be well positioned. But near term, given some of the worries that we talked about, we would be more selective.
Jill, I want to zoom out from just the price action and talk about really the future of small caps as a universe, because something we talk about on this show all the time is that you don't see small companies hitting the public markets in the same way that you did in decades past, that companies are waiting for longer to go public and thus debuting as much larger companies. And I wonder, from where you're sitting, is that structural or just cyclical?
Yeah, we've definitely seen the same, that you've seen companies staying private longer, more IPOs debuting on the Russell 1000 rather than the 2000 than in the past. And there are fewer growthy small caps. So the long-term growth expectations for small caps in aggregate right now, if you look at a consensus 3 to 5 year annualized growth rate for your average small cap, it's something like 13-14%, whereas back in the 90s, it was above 20%. So I do hear that case from some investors, the bear case for small caps, that there are fewer growth stocks, ones that do get public often get acquired right away. But I think there is still an opportunity set there. one just needs to be more selective. Investors have become more focused on higher quality small caps. We've seen that since the IPO boom of 2020 and 2021, when there were a lot of non-profitable stocks that went public and subsequently underperformed. There has been a greater focus on quality and profitability since then. So I think there'll be, more nuanced factors to consider going forward for small caps relative to what we've seen in the past.
All right, Jill, thanks very much for joining us. Jill Carey Hall there of Bank America Securities talking about the small caps. Take a look at the stocks moving at this hour as we approach session highs for the S&P 500 after we get that JOLTS data, after we get a headline that China is considering waiving tariffs on ethane imports. Not sure how big a market U.S. ethane imports is to China, but waiving tariff nonetheless is good. Isabelle Lee joins us. Isabelle, what have you got? What have you got for us?
We're looking at Pfizer's edging higher by 1.5%. The company's first quarter revenue fell short of estimates, but it's maintaining its 2025 outlook. The company is also cutting around $1.2 billion from its spending. That's after it really searches for its next big hit. As we know, the obesity pill failed. But Pfizer also didn't give details on how existing tariffs will impact its business.
Can I just point out that these two things juxtaposed are very interesting.
Yes, exactly.
They maintain their forecast, but they also say that they have no idea about the effects of future tariffs, obviously.
But
right?
investors choose to focus on the positive.
Yeah.
Interesting.
Optimistic
Good
Tuesday.
point.
It's rare to see that because it feels like there's a lot of sad stories out there. One of them is Kraft Heinz. They did have an outlook to give, but they cut it.
This is the sad story for today. No offense to Kraft Heinz. As consumer confidence wanes, they trimmed their annual sales and profit outlook. So the company said organic sales will decline 1.5% to 3.5%. That's down from an earlier projection. They also reduced their adjusted profit guidance, and now Kraft has posted 6 declines in total revenue. So that's really unfortunate. But we have good news. Honeywell, we see the stock edging higher today by as much as 5%. So they raised their full year guidance for EPS, and Honeywell plans to split their company now into 3 separate companies, and they said they will plan a multi-pronged approach to this tariff situation to offset around $500 million in tariff exposure. But the company still says that demand remains uncertain amid all of this volatile environment.
If there's 3 words I had to choose for this earnings season that leads you to winners, it's streamlining, it's dividend increases, and it's buybacks, and buybacks. And Isabelle, thank you so very much for your time this morning. That is Bloomberg's Isabelle Lee. Now coming up, David Solomon, the CEO of Goldman, lays out his view of the uncertain environment. We're going to bring you part of our interview with him next. This is Bloomberg Open Interest.
Thanks.
Let's get out of high interest. Look at what's making headlines around the world. Spain's grid operator says Monday's blackout was triggered by a series of disruptions in the span of a few seconds. So far, that's the most detailed account of the reason for the blackout that spilled over to Portugal. Investigation is still ongoing with conflicting views on whether or not a cyber attack was involved. Leaders of the Canadian Liberal Party, Mark Carney is the main one, has won a narrow victory in Canada's election. Carney's party won about 43% of the national vote, but may fall short of a majority in the House of Commons. His opponent, the Conservatives, they lost obviously the election, and the leader lost his seat after leading in the polls before the election of Donald Trump by 20 points. So blew a massive lead thanks to the U.S. president. Amazon shares are falling as the company plans to show customers the added cost from tariffs. That drew major criticism from the White House.
I just got off the phone with the president about Amazon's announcement. This is a hostile and political act by Amazon. It's another reason why we are onshoring critical supply chains here at home to shore up our own critical supply chain and boost our own manufacturing.
So just showing people what the tariffs cost. Press Secretary Caroline Leavitt declined to answer when asked if the move had strained the relationship between the president and Amazon founder Jeff Bezos, who has sought to curry favor with Trump in recent months. Katie?
Jeff Bezos, who is notably not the CEO of Amazon anymore. But speaking of CEOs, earlier today on Bloomberg, Goldman Sachs CEO David Solomon spoke about the uncertainty looming over markets and over the economy.
We're 100 days in, and I would say there are a handful of policy initiatives that are being put forward. Some of them certainly are very, very interesting and intriguing to the market. But what's been put forward on trade so far has raised the level of uncertainty very significantly. And so I'd say 100 days in, we need another 100 days to kind of see where the policy directives are going and to try to have a better understanding of how what's talked about so far, particularly with respect to trade, is ultimately going to be put in place, how it's going to play out. But the policy actions to date have raised the level of uncertainty to a degree that I don't think is healthy for investment and growth. And I think it's going to be important that we get more clarity on the direction of travel from here.
What, for the markets? So if you look at markets, there's been a sell-off, a pretty dramatic sell-off in U.S. assets. It's somewhat come back, but has it been too drastic?
Well, it's not just for the markets. You know, first and foremost, it's for businesses, it's for individuals. When there's a high level of uncertainty, people tighten their belt, they invest less, they spend less, and all those things slow down growth. And so, you know, one of the things that has happened over the course of the first 100 days is that the perspective on forward growth has been decreased. And so when you decrease, you know, that perspective on forward growth, that changes investors' perspective of equity values. So what we've seen is a relatively orderly kind of repricing of equity assets. And what's unusual in the context of this repricing is generally when you have that kind of equity market stress, people run to treasuries or safe haven, but here we're seeing a slightly different rotation because of the nature of the policy. We've seen a weakening of the dollar, you know, at the margin, and so that's been different than I think what people expected.
Well, are treasuries still a safe haven?
I think U.S. Treasuries absolutely are a safe haven, but you can reprice a safe haven asset as people's preferences shift slightly. You know, I think at the margin, we've had for a long period of time a trend of capital flows into U.S. assets. And, you know, at the margin, people are looking at their portfolio constructions and saying, given the uncertainty that's been raised in the U.S., do we want to rebalance that a little bit? And I'd say the rebalancing so far has been at the margin. Investors can rebalance their portfolio in two different ways. If you're over here in Europe and you have a European investor, they can sell U.S. assets, but also if the relationship between the dollar and the euro changes, that rebalances their portfolio weighting too. And so we've seen that over the course of the last few weeks.
That was Goldman Sachs CEO. Hey, Shanali.
Oh, hi.
That was Goldman Sachs CEO David Solomon speaking earlier. Bloomberg's Francine Lacroix. It plays really nicely into the Wall Street beat,
right.
But I want to just break in for a moment.
Yeah, have to.
If I may,
yes,
with
please.
some breaking news. During that Solomon tape, we got a tweet from a Washington Post reporter. Remember, the Washington Post is owned by Jeff Bezos, also the president and founder of Amazon. Anyway, this WAPO reporter says, Amazon says the team that runs our ultra-low-cost Amazon Hall store has considered listing import charges on certain products. This was never a consideration for the main Amazon site, and nothing has been implemented on any Amazon properties. So basically, through WAPO, Amazon denying that they ever plan to offer this kind of transparency to customers.
We did get a taste of what it looked like, though, to have the White House push back against what was a punch bowl report that says they were planning on doing so. The shares are now paring their losses, now only down about 0.7% as opposed to more than 2% a little earlier. Now, switching back to the Wall Street beat, we're going to talk more about the state of the consumer because we got some earnings. PayPal left its full-year earnings forecast unchanged even after reporting a strong first quarter because of uncertainty in the global macro environment. For more, we are joined by Bloomberg Finance editor Jenny Surane, who knows everything about all these payments companies. I was also interested to see the likes of Visa and SoFi react as well. SoFi putting up some record numbers here. To the extent there are real signs of strain, it doesn't look like you're seeing it yet from these massive consumer-focused finance companies, are you?
No, I think that's exactly right, Shonali. So really what we saw with PayPal this morning is exactly what you just heard about from David Solomon, though, where so far in the first 3 months of the year, consumers are still spending, they're still transacting, especially on the web. You know, they're making those discretionary purchases. But then with PayPal, you know, after such a good quarter, kind of leaving that guidance intact, mentioning that they are in this uncertain macro environment, you start to wonder if they're already starting to see signs that, you know, maybe there is a slowdown in the offing. You heard David Solomon just now say, when there's uncertainty, corporates pull back. You don't want to do as much CapEx. You don't see them going out and wanting to do the big M&A and deals. The same goes for consumers. When there's uncertainty in the environment, you see them really starting to pull back. And so it'll be interesting to hear out of the commentary on the PayPal calls today if they are starting to see any early signs of that consumer slowdown.
One other thing that I think is interesting is SoFi, in the course of their release here, Jenny, had cited the ability to keep lending. In particular, they cited partnerships with the likes of Blue Owl and other private capital firms. How much is private capital now playing a role here in the broader lending story, given that people are really afraid that consumers are kind of maxed out right now?
Yeah, I think it's super interesting because it's still this huge untapped market that you haven't seen. You know, you've seen a lot of interest, but we haven't actually seen a lot of these deals. And so it'll be interesting to see if their appetite changes at all, if that macroeconomic environment worsens. We had Deutsche Bank and HSBC out this morning. They actually did say, you know, we are increasing our provisions. We're setting aside more money in case these loans start to go bad. That was both for corporates and consumers. But you definitely see the banks already starting to warn about it. And so it'll be interesting if we start to see it kind of bleed through to these more really consumer-heavy names.
Jenny, thanks so much for joining us. Bloomberg's Jenny Surane there on the Wall Street Beat. This is Open Interest.
Welcome back to Open Interest. Let's break down this market move right now. It's pretty small, all things considered, when you think about you have more than 300 stocks in the red right now. And really dragging the index down overall is Amazon. A really interesting move here, down about 1% right now. There's been a lot of back and forth over whether they plan to show tariff products on their website. The stock reacting. You can see this reflected in the sector breakdown as well. Also more breadth to the downside. At the bottom, you have energy, and then you have consumer discretionary. Amazon, a big component of that index, leading losses. Coming up, we'll talk about small businesses, their impacts from tariffs. That conversation up next.
What we have seen from our vendors is they are not able to absorb these costs. They're figuring out how much they're actually going to increase their costs to customers. And what we've seen for products shipped from China, we've even seen some manufacturers hold back products and not ship it because of this uncertainty.
And that was Babylist CEO Natalie Gordon speaking to us yesterday. Natalie, it's just one of the many U.S. business owners calling for tariff breaks. With us now is Rebecca Minkoff. She is the founder and chief creative officer of Rebecca Minkoff. Rebecca, also part of a group of small business owners who wrote an open letter to President Trump and lawmakers urging tariff exemptions on small businesses. Rebecca, it's great to have you with us now. Tell us about the response. Have you heard back from any of the lawmakers?
We unfortunately have not heard back yet, but we do know that Trump is listening. As we know with the news, you know, the most recent news, it seems like there is a willingness to listen, whether it's the noise we've made or that in general, you know, small businesses are making across America. And we're crossing our fingers and hoping to get a meeting soon.
How much would it cost to bring production here, Rebecca? I mean, what kind of upcharge would you be looking at? Is it anything compared to tariffs on China?
I think we have to first start with the infrastructure. There is no handbag infrastructure in America anymore besides a couple of small factories in New York City. So not only would we have to build a factory that could make the amount of units we're trying to make, but we'd have to bring back hardware manufacturing, bring back tanning and leather. I mean, these are all things that are purchased overseas and assembled, whether it's China or where we make in Cambodia and Vietnam. And so you're asking for, you know, if you want this to really work, give us grants to build factories, give us several years of tariff breaks in order to make these things happen. And then we'd love to make in America. It just right now, if I were to switch everything to America, my price would double. And my consumer is not here for that.
You have spoken to so many other businesses in this letter. You've given some real world impacts, and you've said that you guys are becoming unintended collateral damage in this escalating trade war. What do you think are the things people really need to understand about how small businesses are faring right now, the damage that's being caused today?
So the damage that's being caused today, and some incredible female-founded brands like Juliet Wines, Brightland Olive Oil, State Bags, is as a small business, we can't afford to absorb these costs like a bigger company can with far larger negotiating power, and we can't pass it on to our customers. So on the handbag side, we're actually choosing to take the margin hit, not pass it on to our customer, because we know with the rising cost of everything else, a $30 impact to her is truly meaningful. And so we are looking at over $1 billion of damage that will be affected if this goes through, with just 40 of the businesses that signed the petition. So we're urging Trump and lawmakers to truly listen to us and give us exemptions.
Well, let's talk about what that means for you and your business, that decision to take the margin hit and to eat that cost. I mean, what does that mean for your planning? Do you have to pull back on hiring? Do you have to reduce headcount, pull back on maybe some planned expansions? What does that actually look like for you?
So ironically, the day that the tariffs were announced was the same week that we were in market selling for Q4 of this year. So our buyers came in all with very pulled back orders and conservative purchase orders, which affects our Q4 outlook. And so once we know the business is going to be less than we thought it was, even if he changed his mind, they're not coming back and saying, we're going to increase our orders, because no one knows with all this uncertainty. So I can't tell you what the outlook looks like yet, but it is going to impact everything you just mentioned, unfortunately. And it's terrible because it impacts people's jobs, their livelihoods, and our ability to expand.
So we just heard from Scott Bessent, and his comments on, I think, tax breaks were a little bit overshadowed by Caroline Leavitt saying it was a hostile move by Amazon to show consumers the cost impact of tariffs. Amazon has now said, hey, we never planned on doing that anyway. So it looks like they've been successfully scared off of that. But I wonder, to get back to his tax point and to underline what you were saying earlier, if they allow you to write off a factory, if they allow you to write off all of the equipment, you still need a reprieve on tariffs while you're building those things, right, Rebecca? So, I mean, the tax carrot is great, but you've still got the tariff stick beating you from behind.
Correct. And also we have to train and hire people who know the craft of making handbags. That's not something you just easily teach someone who graduates from college. And so I think there's so many factors. We need time. If this is going to happen, we need probably 3 to 5 years to build up the infrastructure to support this business again, and then keep that going when the new administration comes in 4 years and changes course. So it's really all about how do we do this in a sustainable way that doesn't change the minute there's a new president.
You brought up some potential solutions here, including targeted grants, but I want to focus on the number one issue you brought up here, this idea of small business tariff exemptions. How likely do you think that scenario would be for there to be a threshold or by employees or revenue that could get you through the door in a way that could help you out when the larger businesses might be disproportionately impacted in a easier way because they have the scale to deal with this?
I think that it's a creative idea. It gives us time. It helps ease a lot of these small businesses where the pressure and our minimums are so much lower. So we have a lot less leverage. We've seen it done with the, microchips and Apple phones. So if they're getting an exemption or they're not going to be charged, I think we feel as small businesses doing under $50 million, keep us alive. We are employing millions of people collectively and affecting livelihoods across the U.S. And so if you really want to make America great again, you should make sure that we don't go away, because a lot of the brands I mentioned will go away.
All right, Rebecca, a somber note to leave that on. Would love to stay in touch. Our thanks to Rebecca Minkoff. Meanwhile, let's going to
Thank
check
you.
on these markets right now. The S&P 500 pretty much unchanged. We've wiggled back and forth. You can see light volume overall. We're down about 20% from our 30-day trading volume average. The Nasdaq 100, similar story, now a little bit higher as we see some of that pressure start to ease up on Amazon. There's been a lot of back and forth, you guys. I will also point out that Amazon reports earnings this week on Thursday. I have to imagine whether or not they're going to show those tariffed prices on their website is going to come up on the earnings call.
So the statement from Amazon, we've got the statement here from an Amazon spokesman, and he says, the team that runs our ultra low-cost Amazon haul store has considered the idea of listing import charges on certain products. Teams discuss ideas all the time, but this was never a consideration on the main Amazon site, and nothing has been implemented on any Amazon properties.
Trying to throw water on the issue before it has to come up on Thursday, as Katie was mentioning. There are a few other things, guys, moving under the surface this morning. Let's talk about them, right? I mean, UPS, this was also impacted by Amazon. Still down now, you know, it was up from what I remember this morning so long ago. Now down about 0.2%. GM also impacted by the tariff story deeply. We're going to hear from them on Thursday as well, with updates after we hear from the revised tariff plans for automakers, down more than 2%. JetBlue also down almost 2%, worried about travel here.
Yeah, all three of those companies have pulled their forecasts for the full year, saying we no longer have any visibility to give it to you. Coming up, we're going to take a look back on the first 100 days of the Trump administration. Today is day 100. Terry Haines joins us from Pangaea Policy. Next, this is Open Interest.
I just got off the phone with the president about Amazon's announcement. This is a hostile and political act by Amazon. It's another reason why we are onshoring critical supply chains here at home to shore up our own critical supply chain and boost our own manufacturing.
Now, that was White House Press Secretary Caroline Leavitt speaking about an hour ago, and she was reacting to a report that Amazon plans to display the impact of tariffs on products. According to an Amazon spokesperson, displaying the tariff costs was never a consideration for the main Amazon site. We're going to now bring in Bloomberg's Mike Shepard, who joins us from Washington, to talk about this back and forth, because, of course, companies in the U.S. are preparing for the potential for higher prices across a wide range of suppliers, companies that list online and not online. If you go to your car dealer, you might see the same thing. What is the reaction from the White House? She got right off the phone with the president and delivered that message less than an hour later, I think. You did see an immediate reaction for the company. Does this set a precedent?
Well, I think that is intended by the White House to set a precedent. Caroline Leavitt, who is one of Trump's closer advisors, definitely has the ear of the president. She was standing there this morning with the Treasury Secretary of the United States, Scott Bessent, as they were talking about this key question of whether companies should be disclosing the cost of tariffs as consumers start to see and feel the pain in increased prices. So the message is clear. If you decide to break out the cost of tariffs and show the impact directly, breaking it out as a line, they consider that a political move and one that is hostile to the administration. And companies will have to remember also that the Trump administration has shown no reluctance when it comes to going after those who it considers opposed to its agenda, opposed to what it is trying to do with the, over the past 100 days and with whatever may come, Shonali.
Yeah, I feel like what we're seeing with Amazon this morning, again, reversals within the hours, is really emblematic, like a microcosm of sort of the trade policy that we've seen over the past 100 days of the Trump presidency. When it comes to trade policy overall, that confusion has definitely permeated across industries here, Mike.
Well, it sure has. Today, though, we're going to see the auto industry get a little bit of a break from the president. He is due to sign an order giving car makers who assemble vehicles here in the United States a little bit of relief from some of the tariffs that he has imposed aimed at the sector and then also aimed at steel and aluminum. So, in short, parts that are imported for cars that are to be assembled here in the U.S., there would be a reprieve on those tariffs, a program of reimbursements on those tariffs if the cars are actually put together here. And also, there will be a temporary reprieve on tariffs on steel and aluminum that go into those cars assembled here. This is something that the auto industry had lobbied heavily for. They are really concerned about the immediate impact of higher costs that go really directly to consumers and squeezing their profit margins as well. And then also the whole question of supply chains. The supply chain for the auto industry is one that has been developed over decades, and it is a cross-border one. It involves assembly and parts plants in Mexico and in Canada, and it really also relies on a flow of cheaper parts from China for some of those low-cost switches and things inside cars as well, Katie.
All right. Hey, Mike, great to have you on the program. Thanks so much for joining us. Bloomberg's Mike Shepard there out of Washington, D.C. Let's get more on day 100 with Donald Trump and 2.0, Administration 2.0. Terry Haines joins us right now, the founder of Pangaea Policy. And Terry, this is great, obviously, for automakers. They don't have to worry about stacked tariffs. They may get some reprieve on foreign-made parts. But if he continues to back down on these tariffs, how is Donald Trump going to raise enough revenue to pay for no tax on tips, no tax on overtime, no tax on Social Security, removing the SALT cap, no taxes, income taxes at all for anyone who makes less than $200,000? That's just a huge ask.
Well, good morning, everybody. A couple of things on that. One is that I think, the Trump style generally is to go in kind of hard, clean, and bold, and then calibrate back from there. I'm not endorsing it. I'm just saying that's the way they do. That's the way they do business, and they judge that the other way to do business, which has been going on for decades of kind of muddling around on policy, doesn't achieve results. So why not? The other thing is that what we've got is a situation where you've got the continuation of tax cuts, the permanence of tax cuts, which would basically be a $5 trillion over 10-year matter. And the Congress is likely to put at maximum probably about $1.5 trillion over 10 years in pay-fors. What you're going to end up with is a lot of that stuff not completely paid for, and that's expected. So, and I think markets expect that. And the bottom line here is I think markets would rather have the tax cuts and not worry about the rest, frankly.
Well, speaking about the rest, before the Amazon comments that we've been talking about all morning that overshadowed the earlier point that Bessent was trying to make about income tax relief, what do you think that this would do in terms of easing some of the pain that you're currently seeing from the tariff policy put out by the administration?
Well, Matt Bessent, to me, made three major points. One is economic policy is national security and vice versa. I think that's important. It's been one of my major themes to markets about what's going on with Trump for months. Secondly, there's a lot of trade deals coming soon, but China isn't one of them. Thirdly, the tariff revenue business. Bessent's view, taken in whole, not just this morning, but taken in whole, is that in a perfect world, you don't have any more tariff revenue because we negotiate trade deals that are so good that everybody takes all their barriers down. Of course, we don't live in a perfect world, so some of those tariffs are going to stay up. What do you do with that revenue? What they're clearly looking at in the litany of things that Matt mentioned a minute ago, no tax on tips, all the rest, combined with how you use tariff revenue going forward, which is basically as an income tax reliever. What they want to do is show sensitivity to working class people that were such a big part of the Trump coalition, and I think they expect both that provides some economic benefit to them, or at least kind of right sizing. Plus, it provides political loyalty, as people like to put it. Those people are now viewed as being seen, and they're gratified by that.
Carey, it's interesting. I mean, we've been asking the question over the past few weeks. I mean, what is the end game of the trade policy? It sounds like you're making the case that it's not necessarily economic. If the goal here is that you wouldn't raise any tariff revenue because, tariffs would be set at zero. If that's the case, what is the end game of all of these trade deals that we're trying to put through?
The end game is much broader than trade. My view is very simple, and I've been consistent about this for forever, for what it's worth. Is it's not a trade war, and Trump didn't start it. That's how they think of it, certainly, and that the status quo is a situation where, among other things, the intention of China, for example, is to continue to kind of suck industrial life out of this country and out of the West more broadly, and markets know that and understand it, because that's the predicate behind how automobile companies, whether they're in Europe or even in the United States, are being used today, is the concern about flooding of cheap Chinese EVs and all the rest. So there's a lot of concern about that and a desire to right size it. So what they're trying to do is frankly reset the economy in a different way, the United States economy in a different way that not only has broader and more sustainable economic benefits, but also puts the United States in the best geopolitical position to kind of make deals compared to the rest of the world where the economies aren't half as good. Their agenda, and again, just stating what they're after, is that they're interested in improving U.S. geopolitical strength, and they're interested in improving and sustaining U.S. economic strength. They think that the rest of that agenda, tax cuts, and what they call energy dominance, deregulation, and the like, all of which Besant hit on this morning, is the path to that, and that markets and the broader public will see benefits of that starting in the second half of this year.
If we don't, Terry, I mean, if we see higher prices because 70% of the goods Amazon sells are made in China, and if we see what Torsten Slok calls a voluntary trade reset recession, which more and more people are putting higher odds than 50% on, how does this play out for the Republican Party in 2026 and again in 2028? I mean, could they be shooting themselves in the foot right here?
Oh, they'd be shooting themselves in the head, I think, Matt. And they know that. I saw the House Tax Writing Committee Chairman Jason Smith on your air yesterday, and Smith talks about this in terms of we absolutely have to do this, meaning the tax cuts. They will say to you that publicly and privately, we have to achieve all of these things or else we'll fail. The former USTR, Bob Lighthizer, makes a very persuasive case on this. I saw him interviewed recently on it, and the last question in the interview was, well, what if you fail? What if you're wrong? Lighthizer's response, without even hesitating, was, we can always go back to the old way of failing. That's how, I hate to use the word existential, that's how existential they think this is and how focused they are on getting it done.
Terry, we thank you so much for joining us this morning. That is Terry Haines of Pangaea Policy. And tonight, tune in to Balance of Power as President Trump marks his 100 days in office. We're going to have extended coverage of his speech from Warren, Michigan. This is Bloomberg Open Interest.
Welcome back to Open Interest. You can see the S&P 500 managing to poke into the green right now, up about 0.2%. It's not a big move, but if this holds, this would be the 6th consecutive day of gains, which we certainly haven't seen in a while here. So we'll see. But again, a lot can happen between now and 4 p.m. What we do know is that we're in earnings season, and the name of the game seems to be pulling guidance. Just this morning, you had GM, JetBlue, UPS all pull their guidance. You had Pfizer maintain, but then on the other side, you had Kraft Heinz pull or cut their guidance there. So clearly that seems to be the move.
I feel like Kraft Heinz, I mean, they were going to do it anyway, right? They've had 6 quarters of declining sales. Organic sales growth was like
It's tough
a
out
drop
there.
of 5%. For them especially. So
Yeah.
for them, this is a great excuse. But for everybody else, there's just no visibility.
No visibility, but if you came in kind of with a fortress positioning, then you might be able to weather all of this storm a little better. You saw IBM raise their dividend this morning. Coca-Cola.
Okay, if you sell something addictive, so if you sell cigarettes or caffeine,
Kraft Heinz sells ketchup.
Wells Fargo
Apparently that's
boosting
not.
a buyback. Sherwin-Williams on the rise. So not all is bad out there.
All right, coming up tomorrow, we have former Bridgewater chief investment strategist Rebecca Patterson, plus the CEO of Norwegian Cruise to talk about why people are still booking trips on these boats.